Hi, welcome to Pauline Yong's channel. If you like our videos, please click the like and the subscribe buttons. Also, please comment at below and to submit your area of interest. Malaysia's plantation sector is one of the biggest contributors to Malaysia's GDP growth. Last year, we saw the plantation sector index decline by 5.9%. In this video, we are going to cover the plantation sector and to see if there is any buying opportunity. We will also rank this sector stock according to their market capitalization. The plantation sector is off to a good start in 2021 as FCPO continues to extend its uptrend prices from 2020 to trade above 3,200 ringgit per ton. From the chart, we can see that the FCPO fell below 2,000 ringgit per ton in May 2020 and it had a V-shaped recovery due to shortage in the supply caused by the MCO. And as at 18th of February, it was trading around 3,500 ringgit per ton. According to the statistics, palm oil industry climbed by 4.7% month-on-month to 1.33 million tons in January 21, as lower output was more than offset by the sharply lower exports. Stockpile will likely remain at low level in coming months, as seasonally weaker export demand from China will be offset by low production due to seasonal factor and labor shortages and flood in some parts of Malaysia. The following are the various fund houses' CPO price assumption for financial year 2021. AmInvest maintained their CPO price assumption of 2,700 ringgit per ton for 2020 to 2022 and a neutral stance on the sector. AmInvest assumed 2,500 ringgit per ton for 2021. And KENAGA assumed 2,600 ringgit per ton for 2021 and offer a neutral stance on the sector. Public Invest assumed above 3,000 ringgit per ton in the short term until February 2021. The concerns for this sector are: number one, Indonesia's CPO companies are still trading at a discount versus Malaysian peers despite their recent levy imposed by the Indonesian government. CPO prices may not be sustainable at the current high level as the falling stockpile is absorbed by the falling demand. Exports plunged 42.3% month-on-month to 947.4 thousand tons in January 21, with exports to key export destinations namely China, India, and EU declining by 23%, 74.7%, and 29.4% month-on-month, respectively. The weaker demand was mainly due to the seasonal factor, as demand for palm oil is historically low during the winter season. And also the industry is in shortage of labor by 70,000 workers according to the Malaysian Palm Oil Association MPOA. This is due to the current freeze on the recruitment of foreign workers due to the COVID-19 pandemic. Many workers were sent back upon their contracts expired. This resulted in the loss of productivity at over 16 billion ringgit per year. The next section, we will rank the plantation sector stocks according to their market capitalization. Rank number 1 is IJMPLNT Plantations Berhad with a market capitalization of 34 billion ringgit. IJMPLNT Plantation is the world's largest palm oil plantation company by planted area. The company produces approximately 2.5 million tons or 4% of the world's crude palm oil CPO output annually, of which about 2.4 million tons are certified sustainable palm oil (CSPO). AmInvest estimated that group FFB yield would be 20 tons per hectare in financial year 21 versus 19 tons per hectare in financial year 20. What is FFB? FFB stands for Fresh Fruits Branches. FFB. On average, fully mature oil palm produce 18 to 30 metric tons of FFB per hectare. In terms of the production cost, it is believed that IJMPLNT plantation cost of CPO production would be flat in financial year 21 as higher palm kernel credits compensate for increases in the cost of wages. The group sales grew 12% year-on-year to 3.1 billion ringgit, driven by stronger sales contributions from upstream Papua New Guinea year-on-year with a positive gain of 6.2% and the downstream year-on-year with a positive gain of 21%, which were offset by weaker performance in upstream Malaysia year-on-year negative of 37.4% and the upstream Indonesia year-on-year negative of 24.9%. The stronger upstream sale in Papua New Guinea were driven by improved CPO prices and higher FFB production, as well as stronger sugar sales. As at 17th of February, the plantation was trading at 4 ringgit and 95 cents, PE 37, ROE 6.8%, profit margin 7.2%, dividend yield 0.8%, debt equity 0.5. Cash reserves stood at 695 million ringgit. Here are the target price by the various research houses. Rank number 2 is IOICORP Berhad with a market capitalization of 26.8 million ringgit. IOICORP Berhad is engaged in the cultivation of oil palm, processing of palm oil, and investment holding. The company operates in 2 segments, plantation and resource-based manufacturing. According to AmInvest, the IOI's fresh fruit branch FFB production will yield 22 tons per hectare in financial year 21 versus 21.2 tons per hectare in financial year 2020. IOI is envisaged to replant about 12,000 hectares of aging oil palm trees in financial year 21, compared to 10,000 hectares in financial year 2020. The replanting is expected to offset enhancement in the FFB yields in the 2021. It is further believed that IOI would continue to be on the lookout for investment opportunities in the coming 6 months. The group has not carried out a major acquisition since the 1 billion ringgit takeover of Unico Desa Plantation in 2013 and 433 million ringgit acquisition of the Creamer Oleo GmbH in 2015. The deadline for the utilization of the 925 million ringgit proceeds from the disposal of Loaders Coquelin is third quarter of 2021. If the group is unable to find investment opportunities at the right pricing by third quarter 2021, they may use the cash to repay borrowings or pay additional dividends. Assuming half of the 925 million ringgit are used to pay dividends, these would translate into additional dividends of 7 cents. IOI Plantation has solid fundamental as their quarterly earnings picked up strongly in the Q4 2020 onwards, due to the rising CPO prices. As at 17th of February, the company was trading at 4 ringgit and 26 cents with a P/E ratio of 36.7, ROE 7.9%, profit margin 8.6%, dividend yield 1.88%. Its debt equity ratio was 0.5 and it has a huge cash pile of 650 million ringgit. Here are the target price by the various research houses. Rank number 3 is Kuala Lumpur Kepong Berhad KLK with a market capitalization of 25 billion ringgit. KLK registered the first quarter financial year 2021 core earning net profit of 275.4 million ringgit, a gain of 54% year-on-year or a gain of 40% quarter-on-quarter, due to higher than expected CPO price overshadowing lower than expected first quarter 2021 FFB output. KLK's average realized CPO price of 2,703 ringgit was lower than the MPOB's average spot price of 3,341 ringgit per ton. This is due to the forward sales of the CPO carried out at lower prices and weaker CPO price in Indonesia. In Indonesia, the CPO price was more than 500 ringgit per ton lower than the Malaysia in the fourth quarter of 2020 due to the country's CPO export tax and levy. KLK has significant exposure to Indonesia as about half of the KLK's FFB production come from Indonesia. KLK has strong fundamental as their quarterly earnings picked up strongly in the third quarter of 2020 onwards, due to the rising CPO prices. As at 17th of February, the company was trading at 23 ringgit and 20 cents with a P/E ratio of 32, ROE 7.1%, profit margin of 4.9%, dividend yield 2.16%. Its debt to equity ratio was 0.59 and it has a huge cash reserves of 2.9 billion ringgit. Here are the target price by various research houses. Rank number 4 is Ign Plantations Berhad with a market capitalization of 8.5 billion ringgit. Ign Plantations Berhad, formerly Asiatic Development Berhad, provides plantation, property development, property investment, genomic research and development, and downstream manufacturing activities. Ign Plantation is expected to benefit not only from higher palm oil prices and production in the 2021 financial year, but also earnings recoveries in the premium outlets and the downstream division. It is expected that Genting Plantation's 50% share of the net profit in the premium outlets to rise by 20% in the financial year 2021 as the number of visitors improves on the easing of travel restrictions in the second quarter of financial year 2021. Share of the net profit in the premium outlets is estimated to account for about 12% of the Genting Plantation's financial year 21 net profit. In addition, Genting Plantation's FFB production is estimated to expand by 8% in the financial year 2021 compared with the fall of the 6% in the financial year 2020. Underpinning the increase in the group's FFB output in the financial year 21 are enhancements in the FFB yields and an increase in the mature areas in Indonesia. Genting Plantation FFB yield is estimated to be 19 tons per hectare in the financial year 21 versus 17.9 tons per hectare in financial year 2020. As of 17th of February, Genting Plantation was trading at 9 ringgit and 53 cents, PE ratio 36, ROE 4.9%, profit margin 9.86%, dividend yield 2.7%, debt to equity 0.55, huge cash reserves of 979 million ringgit. The following is the target price by various fund houses. Rank number 5 is FGV Holding Berhad with a market capitalization of 4.8 billion ringgit. The company's segments include palm upstream and downstream activities. It also engaged in the sugar production, refining, and sale and marketing of refined sugar and molasses. On the 8th of December 2020, Federal Land Development Authority (FLDA) had entered into a conditional share purchase agreement to acquire a collective 13.88% stake in the FGV or 250.85 million shares from Kumpulan Wang Persaraan KWAP and Urusharta Jamaah Suria Berhad at 1 ringgit and 30 cents per share. Upon completion of the shares acquisition, FLDA together with the persons acting in concert, PACs, will collectively own more than 50% stake in the FGV, which has in turn triggered a mandatory takeover offer MO for the remaining shares it does not own at 1 ringgit and 30 cents per share. The largest move represents an opportunity for FLDA to obtain statutory control of FGV together with the PACs in order to pursue its transformation plan, which potentially involves terminating the land lease agreement with the FGV and taking over the related palm oil mills, and restructure FLDA and its related companies to strengthen its core business in the plantation sector. Due to the termination of the land lease agreement, FGV's palm oil land bank would drop by almost 80% to about 77,875 hectares. However, this would improve FGV's cash flows. FGV would not have to pay between 250 million ringgit and 300 million ringgit for the lease of the land and replanting expenses of more than 200 million ringgit every year. However, it is believed that the mandatory takeover offer price of 1 ringgit and 30 cents per share does not reflect the improving near-term earnings prospects of the company from the rising CPO price since third quarter of 2020. Nevertheless, as at 17th of February, FGV was trading at 1 ringgit and 31 cents, PE 52, ROE 2.2%, profit margin 0.69%, dividend yield of 1.5%. Debt to equity ratio of 0.88 and the cash reserve stood at 1.7 billion ringgit. The following is the target price by various fund houses. Rank number 6 is Sarawak Oil Palms Berhad SOP with a market capitalization of 2.3 billion ringgit. The company is engaged in the cultivation of oil palms and the operations of the palm oil mills. Its segments include oil palm and property development. Its business divisions also includes plantation milling, downstream marketing and trading, and property development. Its upstream of oil palm estates and mills are located in the state of Sarawak. The upstream operation of Miri-based plantation company includes the development of oil palm plantations, cultivation of oil palms, management of estates, milling of fresh fruit branches FFB for crude palm oil, and palm kernels. SOP's net profit grew 74% to 30.91 million ringgit in the third quarter ended September 30th from 17.73 million ringgit last year, thanks to margin improvement in palm products. Earnings per share increased to 5.41 cent from 3.11 cent. The earnings improvement came despite an 18% drop in quarterly revenue to 716.31 million ringgit from 870.34 million ringgit due to lower palm products average realized prices and lower volume of the palm products sold. For the first 9 months of financial year 2019, its net profit fell 25% to 40.93 million ringgit from 54.33 million ringgit last year, as revenue fell 20% to 2.05 billion ringgit from 2.55 billion ringgit. SOP has strong fundamental as at 17th of February. It was trading at 4 ringgit and 8 cents, PE 10, one of the lowest among the players, ROE 9.9%, net profit margin 8.3%, dividend yield was generous at 5%. Debt to equity 0.49 and cash reserve stood at 916 million ringgit. The following is the target price by various fund houses. Rank number 7 is IJM Plantations Berhad with a market capitalization of 1.4 billion ringgit. IJM Plantations Berhad is an upstream agri-business company involved in the oil palm industry. The group's oil palm plantations spanning a total land area of approximately 60,981 hectares are located in Sabah, East Kalimantan, and Sumatra. The group has 6 palm oil mills with a total FFB processing capacity of 300 metric tons of FFB per hour, which are strategically located in close proximity to its plantations. The 4 palm oil mills in the Malaysian operations command a total processing capacity of 180 metric tons of FFB per hour. The remaining 2 mills are located in the Indonesian operations and have a capacity of 120 metric tons of FFB per hour. IJM Plantations Berhad net loss narrowed to 1.04 million ringgit in the second financial quarter ended September 30th, 2020, from 2.32 million ringgit in the previous corresponding quarter. The plantation group's performance in the second quarter of 2021 was dragged down by foreign exchange loss of 34.97 million ringgit on its US dollar and Japanese yen denominated borrowings, compared with a forex gain of 91.74 million ringgit in the first quarter of financial year 2021. Fresh fruit branch production in Indonesia declined by 20.1% to 117,473 tons in the second quarter of 21 from 146,975 tons in the first quarter of 21. Crude palm oil sales declined by 19.7% to 36,077 tons from 44,936 tons in the first quarter of financial year 2021. The group could continue to face pressures arising mainly from adverse weather impact disrupting crop production, the uncertainty of commodity prices, and the volatility of the foreign exchange rates, particularly that of rupiah against the US dollar and the Japanese yen. However, IJM Plantations Chief Executive Officer Joseph Tech said that the recent steep downward revisions of crop estimates in the other competitive veggie oil, sunflower and soybean will have helped to support the CPO prices above 3,000 ringgit a ton. As at 17th of February, IJM Plantation was trading at 1 ringgit and 64 cents with a PE ratio of 58, ROE 1.9%, profit margin 2.9%, dividend yield of 1.2%, and debt to equity ratio of 0.7. Cash reserves stood at 268 million ringgit. The following is the target price by various fund houses. Number 8 is Tsh Resources Berhad with a market capitalization of 1.4 billion ringgit. Tsh Resources has several plantations and mills across Sabah, East Malaysia, as well as parts of the Sumatra and Kalimantan, Indonesia. With its humble beginnings in Sabah, Tsh has built up its plantation footprint and activity with aggressively expansion of its land bank in the region. Their plantations, including associated companies, are strategically located with approximately 50,000 hectares in planted areas across Sabah, as well as parts of the Kalimantan and Sumatra, Indonesia. They also have approximately 65,000 hectares of unplanted land bank in their portfolio. Besides plantation, TSH also ventured into the renewable energy space with biomass power and biogas power. Their palm oil bio-integration approach taps into huge commercial potential of bio-waste of the palm oil industry through a fully integrated complex in Kuna, Sabah. In terms of earnings, TSH experienced a dip in the first quarter of 2020 due to the pandemic, but the company had a strong rebound in earnings for the Q2 and Q3 of 2020. Its Q3 earnings gained 21.45% Q-on-Q to 27.04 million ringgit, followed by a 779% gain in the second quarter of 2020. As at 17th of February, the company was trading at 1.04 ringgit with a PE ratio of 22, ROE 4.6%, profit margin 7.1%, dividend yield of 0.9%, debt equity ratio of 0.98, and a cash reserve of 130 million ringgit. The following is the target price by various fund houses. Rank number 9 is Hubsling Plantation Holdings Berhad with a market capitalization of 1.4 billion ringgit. The company, through its subsidiaries, is engaged in the cultivation of oil palm and processing of fresh fruit branches. The company's total planted area includes approximately 35,680 hectares out of a total area of over 39,800 hectares. Of the total planted area, approximately 32,440 hectares are mature areas. The average age of the palms of the planted area is over 15.5 years. The company operates through 4 oil mills, namely Jeroko Palm Oil Mill 1, Jeroko Palm Oil Mill 2, Tomangkong Palm Oil Mill, and Bukit Mas Palm Oil Mill. The company has a combined milling capacity of approximately 170 fresh fruit branches tons per hour. Hubsling Plantation net profit surged to 25.08 million ringgit in the third quarter of financial year 2020 versus 102,000 ringgit year-on-year. Revenue also jumped 47.33% to 128.9 million ringgit from 87.49 million ringgit year-on-year. The better quarterly earnings were due to higher average selling prices and sales volume for the crude palm oil and palm kernel. For 9-month financial year 2020, the planter's net profit skyrocketed to 53.35 million ringgit from 283,000 ringgit a year prior. Cumulative revenue was also higher by 7% at 314.33 million ringgit from 293.74 million ringgit in the corresponding 9 months last year. As at 17th of February, Hubsling Plantation was trading at 1.86 ringgit, PE 16.8, ROE 5%, profit margin 19%. Dividend yield was 1.98%. It has a zero debt to equity ratio and its reserves is 60.9 million ringgit. The following is the target price by various fund houses. Rank number 10 is KMLOONG Resources Berhad with a market capitalization of 1.3 billion ringgit. The company is engaged in the cultivation of oil palm. The company operates through 2 segments, plantation and milling. KMLOONG Resources Berhad, second quarter financial year 2021, net profit surged 224.4% year-on-year to 33.2 million ringgit. Boosted by the higher average CPO prices at 2,360 per metric tons versus the 2,007 per metric tons recorded in the previous corresponding quarter, alongside with the higher production. Revenue for the quarter climbed 54.2% year-on-year to 238 million ringgit. The big improvement in the financials was mainly due to the rally in the CPO prices. KMLOONG Resources continues to maintain a healthy tree profile. Immature is 15%, young mature is 6%, prime mature 35%, old mature 29%, and pre-replanting of 15%, of which approximately 70% of the group's palm trees will be able to generate sustainable earnings over the foreseeable future. As at 17th of February, KMLOONG was trading at 1 ringgit and 40 cents with a PE ratio of 15, ROE 10%, profit margin of 9.7%, strong dividend yield of 5%. It has a low debt to equity ratio of 0.06 and a strong cash reserves of 258 million ringgit. Overall, we remain neutral stance in the plantation sector as we believe the CPO prices will be trading within 2,700 ringgit to 3,000 ringgit for 2021. The reduction in the output is likely to be offset by the weaker demand from the exports markets. The above analysis is for information purpose only and we do not initiate a buy call or a sell call. At the point of recording, we do not hold any of the stocks mentioned in this video. Thank you.